and the opportunity cost of doing nothing has never worked really for anyone, has it?
No.
Keeping money as cash.
There's 15,000, they say 15,000 suburbs to invest in Australia. There's really about 4,200 or 4,600. That's 4,000 options versus the 3 that we're hearing of.
Property prices have outstripped wage growth for a long period of time. So it's been a great vehicle for people to use, equity from, leverageable equity supported by their earnings to get ahead.
Yep.
Rates are probably back at their peak. This week we've had some announcements by some major banks.
Which were totally unexpected if you were to say, look 3 months ago.
If everyone slows down and has a thirst for information, that's probably the key takeaway here, right?
Welcome back to another episode of the Lazy Equity Podcast. Today we are joined back again in the studio by Ben Robinson from Flint Group, the director and partner of Flint Group. And a very good friend of ours and a partner to what we do for our clients, obviously buying investment properties, and helps with us getting really good and competitive loans across to our clients. But more importantly, the strategic underlying factors that get played in a part of the decision making of what those strategies look like for the financing and the funding approach. So Ben, thanks buddy again for joining us. We love having you in the studio.
Mate, good to be back.
Always, mate. Thanks for driving down from Newcastle. I know you come down every single time to see us alone, right? It's just us.
Yeah. Well, I dropped in to see the team this morning, and one of them made the joke that it was sort of I was doing a podcast for the podcast with some of the in-depth chats we have, but we all love what we do, right?
Yeah, we do.
Property and finance.
I've had a big morning of chats actually. I've already done a podcast before you came here. We've been chatting for about an hour already, and now we're into pretty much discussion number 3 for the day. So we'll see how tiring the voices get and how much we can bang out in a short amount of time. Mate, the big thing at the moment for us is sentiment. The federal budget's come through. There's been so much distortion of the right thinking process and concept of what the property market's going to do at the moment, because people are so scared around all this bullshit that's been put into place around the ideas and the ideations of what property markets are going to do. Part of what I want to unpack around this is the reality of the economics of geography and funding through building business from the original roots of being paid by employment, which I'll get into in a minute. But really, just to sort of understand as well, a lay of the land from your perspective, what you're seeing from the mortgage broking side of the world.
Yeah, so it's very much a two-speed economy. I think that's what I was saying this only yesterday, where you've got your people that are seeking knowledge and they really want to understand how these proposed changes are going to impact their position now and ongoing. And then you've got your people that are blinded by the media and that want to dig their heads into the sands for a bit. So, if we look at the sophisticated side of things, we've got an opportunity where rates are probably back at their peak. Mm-hmm. This week we've had some announcements by some major banks.
Which were totally unexpected if you were to say, look 3 months ago.
Yes.
And this is again the rates of change that we're in. And the stability of the markets. Where do you look for safety? Where do you look for reliability?
Yeah, and I was saying this for the last couple of months. I think that the rates needed to go up for inflation, but I didn't know if they would go past the ceiling that we had about that sort of 15 to 18 months ago, where rates hit a peak, they stayed there for a while, inflation came back down under similar market factors now, because if they go too high and inflation drops rapidly, there's a rise in unemployment, then we start seesawing again. Yeah. And that was my biggest concern and frustration start of this year end of last year there was, hey, rate cuts are coming, rate cuts started this year, and that the sentiment, rates start going down. The dollar effect on most households, a lot of people don't even know. Yeah. Like, I don't even know how much my rates have changed or what the repayments are.
True.
But it's all sentiment. So, you've got rates coming down, money becoming cheaper. Property did really, really well. Spring last year in a lot of locations was a very, very big competitive time, and it's something that we hadn't seen for a little while across most markets.
Yeah.
Okay. Then start of this year, we've had rates going up, which again didn't affect sentiment too much, but I think the looming budget did. Then post-budget, it's obviously a bit of a blindside from the Labor government that doesn't really affect anyone positively. Yeah. And it's really affected those younger investors, those accumulators without asset bases.
I think you've actually just shone a light on something there, potentially knowingly or not. But the idea of interest rates fluctuating and the property prices continuing to drive, people become used to this fluctuation because we've experienced this so much over the last 5 years. And, look 5 years ago when the fluctuations were so aggressive, people were very, very skeptical around what that actually meant for property prices, to the point where sentiment was dropping at those stages. As people became used to these things, they started to realize that these are not necessarily the driving factors for property prices. Yes, they do change holding positions and the costs to hold the asset, but do they change necessarily the amount of competition coming in? Competition is obviously driven by supply and demand. We know those are the fundamental factors, but they don't play a part when the interest rates are necessarily fluctuating so much. That's a sentiment game. But the more that happens, the more comfortable people get with it, and therefore the sentiment then drops. Raises rather.
Well, raises, and it just becomes the new norm, right?
Yeah,
like when rates were at the top, the 4.35% cash rate, back there again. Once people have, confidence around the income, the income is now going for their house, and the fact that they either need to upsize or they've got a good amount of equity to use for an investment. These are variables that, they can control internally. It's how much you're paying down your loan, how much liquidity you've got in offset, and how much capital you want to deploy.
And this is the education that people are getting so much easier these days. And again, that's why sentiment hasn't been a factor from those rates, because there's manageable education around it all, which has always been around. It's just the education is now more available to people.
Yeah, and I think people are taking financial matters into their own hands a little bit more, and I think they've needed to, especially where, and I was only saying this to one of the other brokers in the office this morning, it's COVID, cheap money, you could go buy stuff that was very good value went up, you had a number of rent rises in there as well for these properties, so they're, slightly negative, neutral-ish, and it wasn't really a concern. Then obviously rates went up, stuff's becoming more negative for a lot of those investors that are either PAYG or pull a reasonable sum of money out of the business. Negative gearing's great. It tops up liquidity on an annual basis when you get your returns done.
But I think also it goes back to the point of where we were so used to seeing fluctuating rates that it became comfortable and understood. This is something brand new, and that's why the sentiment is so low, is because these announcements are... it's not brand new. We saw it in 85 with the Howard government. I think it was the Howard government. And that had astronomical effects. Whether they were directly related, debatable, but it was a very long time ago. And so people have forgotten what happened then. And a lot of the investors these days obviously, weren't even born in 85.
And even if we look back sort of pre-COVID, there was a period there, which again, what was that, probably 2019, where I can't recall what the cash rate was off the top of my head, but market rates were in the sort of fours. Okay, like 3s to 4s, and that was a time where a lot of people were actually trying to jump into fixed rates. Rates weren't going to spike. They might have gone and wanted, the if I remember correctly, it was 25 to 50 basis points. That was what the RBA was projecting they wanted to do. Then we obviously fell into COVID, so there was a nervousness at that time. There was a lot of people that jumped into fixed rates at 3.9, 4.1%. Then the cash rate dropped, and so for that period where you had sort of value skyrocket in 2020 and 2021, there was we were breaking a lot of fixed rate agreements with expensive break costs to be able to move those funds to a different lender. But then doing the cost benefit on that, in a lot of cases it made sense. And then if we looked at the opportunity cost of what the extra funds were going to do to buy another investment, there's a lot of people that made a lot of money out of that. But back to the point on rates, it's a standard part of the cycle. 25, 50 basis points here and there. It's just unfortunate that we had really cheap money. Money had to go back to a normalised cost. Then, funds became a little bit cheaper. Funds have gone back up. So, if a cash rate can sit with a 3 in front of it, mid-3s, I think that's a fair cost of money, because you can still invest to earn a return. You can't invest in anything and hope to make money like COVID. But the last 6 years, there's a lot of property investors that have made a lot of money, but it's not, that's not your typical cycle where there's been so much external input from the central bank to try and control inflation and pricing of assets.
It's It'll be an interesting time to see what comes of this announcement. I think, what's your take? Where do you think things are going? I mean, there's been so much speculation on social media around the opinions from people, but also the broadcasting inside Senate and what's actually happening. Mate, Labour's being ripped apart.
They're being ripped apart because they came out and they wanted to disincentivise property investment, which I'm not for or against. I think there might need to be some limitations on it potentially. Maybe we limit negative gearing to a number of properties held, because we can't just decimate rental supply. Yeah. If we grandfather it, everyone's just going to hold on to assets. So that's not releasing, supply for other people to buy, to own or occupy. It's not an easy answer, but I genuinely don't know I don't know what they're going to do.
Yeah,
I gut feel is that there'll be some change to the proposed CGT changes. I think they're too aggressive, and I think they've done it across all asset classes as well. So even your young investors that are trying to put some money into shares, and that's how we started. Earning a buck, investing in shares. That was a mixture of blue chip. Well, yeah, but blue chip stuff. It was your CBAs, your Macquaries. I think back then AFG as well. There was a few different ones, but then there was a few of those specky ones, and we made quite a bit of money out of that. But again, that was pure luck that we pulled out at the right time. There was a few of those specky ones we had to pull out to buy properties because we needed the deposits. Yeah. That we, in hindsight, were great moves, but we started in shares. If the government is taking 50% of gain out of shares, you're depleting people's capital to then go buy property to live in or to invest.
There's been so much short-sightedness around the decisions that they were trying to enforce or potentially are still trying to enforce. I just think it's more than just a single issue. It's more than two single issues. It's more than capital gains, and it's more than a negative gearing policy change. It really comes down to red tape. Again, we talk about this so many times, and I'm almost sick of it as well. But the actual, limitations around being able to develop. It comes down to the borders being open to the people who have almost free will, who are absorbing the stock inside the markets, that take the benefit of being Australian almost away. Doesn't really make sense. Saying this as an expat Safa who is now Australian, but it's more than just a capital gains tax. It's more than just a negative gearing policy change. It's so much more broad than that. And I think this is where all the politicians are having a field day at campaigning their own little political point of view. We see One Nation wanting to close the borders to everybody. We see the Libs trying to pull apart everything that the Labour's putting forward in front of money making and properties.
Well, at the moment, there's just no balanced opinion.
No, that's
it's either
the thing.
This side, this far this side or far this side.
100%.
That's why I genuinely don't know what's going to come out of this.
Yeah.
Like I don't know how watered down the changes are going to be. I don't know if they're going to come in for a period of time, and then be opposed and reverted. But if we bring it back to sort of advice for clients at the moment, it's block out the noise. This is not just affecting you, it's affecting everyone. Yep. There are ways we can navigate around some of these to mitigate the effects, and that's the most important takeaway. So transactions are slower at the moment, but in a good way. Of clients are coming in, we're putting stuff together, we're running analysis on capacity, we're talking about price points that make sense and what asset classes we can get into. We're then potentially going to accountant to make sure that we understand the impacts of setting up separate ownership structures, and then we're buying, the right assets by getting advice from buyers agents. That's the way to do this, because I think there are sort of markets at the moment that you could put your money in and go backwards, and these are your mortgage bands, these are your Sydney and Melbourne, and I know that's a very, very general term.
But that's what we hear about.
But they're really talking about, those double incomes. They might not own investment properties, they might own one, that when rates go up, people hunker down, they don't upsize their PPRs. Values slump because, clearance rates at auction go down. But a lot of investment properties don't even go to auction. So we're looking at auction clearance rates for PPR purchases.
25% of properties are auctioned in Australia. 75% are not. Those 75 are through private treaty sale. And that's the...
and the 25% then go onto the clearance rates that then get broadcasted by the media.
Yeah, exactly. Yep. So, and there's a sort of false data set of sentiment. And again, that goes back into line with what you said there. It comes from three places, mostly Brisbane, Sydney and Melbourne. And that's the familiarity of where the major population of Australia are really residing. Not necessarily just those three, but obviously the capital cities.
Yep.
Right now. And I want to put up a bit of a geography look on this a little bit of a lens in a grander scheme. Now, obviously, don't take this chalk for chalk, but we are a country which is the same size as the US, almost, right? We're not that far off in land size. If you look at the US, there's 50 states. They've got a population of, I think it's 349 million or something like that people. We've got 8 states and territories, and we're a population of 28 million people. Significantly less, but the reality here is that the density of our living is so much more than theirs.
Yep.
And that's because we have such few areas to pick our major economic hubs of employment. And so competition will naturally drive inside these areas.
Yep.
The States has got, I'm trying to remember the number exactly, but I think it's 2,600 statistical areas, or urbanized areas, sorry. In Australia, we call those statistical urban areas, and we've got 110.
Yep.
Versus the 2,600. Basically, a statistical urban area is like Townsville, Geelong, could even be Sydney, basically anywhere that creates economic diversity and employment towards over the population of 10,000 people per capita area. Mm-hmm. I know this because this is how we build our prediction modeling. But because of that, understanding the geography and the density of population and the limiting choice of people due to the density, it's naturally going to be understood that once there's such a competition concentration, those people that need to buy property to live in the area where they need to work to create their employment are going to naturally bid up those property prices. You've got a Labour government that's bringing in anybody into Australia to go and fuel that demand even further. Don't get me wrong, we do need migration.
Yes.
And I think it just needs to potentially be controlled better. So I'm definitely not on the Pauline side, but I'm definitely not on the Labour side. I think there's a balance, and that's kind of what we were suggesting there earlier. But the reality here is that geographically, as we sit as a nation in Australia, there are many, many, many years ahead of us until we can sort out the demand factors that drive property prices. And the noise that we're hearing right now plays none a part of that. And with the noise that we've been hearing for the last 10 years has played none a part of that. The property prices will continue to grow because supply and demand factors are the fundamentals, and they will continue to be.
And that's the thing we need to rewind to, I guess, is before we had the talk of, budget outcomes, what was going to get delivered in the budget. We were facing a market end of last year that was running hot across a lot of locations.
Yeah.
On the back of, slightly cheaper money, again, sentiment driven, again, fueled by undersupply. Nothing has changed on the supply side, just the demand has moderated, which is a great time for people to buy. But does feel more uncomfortable for people going against the grain, but that's when you're going to make the most money. Using those times where you're not getting as many people through open homes.
Who wants to buy at the top of the market?
Yeah,
nobody.
That's what we say. And there's a lot of people going, the market is going to slump, and it's like, it might moderate. That's cool. I'd rather buy on the way down near the bottom than trying to spend drug money on something against 10 other people. With New South Wales with a race to exchange. We've done a few of those where the agent's gone the first person to exchange wins it. But
this is the crazy thing. Again, going back to the media, focusing on 3 key areas, Sydney, Brisbane and Melbourne, being these property markets are going to crash. We watch this all day, every day, and we have for the last 5 years, and this is exactly how we're positioned where to buy. We're waiting for property markets to hit the bottom so that we can know when they are at the bottom so we can buy up from there.
Yep.
That hasn't changed as our business model. Now the fact that the media is positioning 3 major areas to be these factors, cool. They say 15,000 suburbs to invest in Australia. There's really about 4,200 or 4,600. And an investable suburb, by definition, has to have transactional data for rental and sales to a certain percentage. Again, this is our crystal data. But that's 4,000 options versus the 3 that we're hearing of.
Yeah.
Where's the logic?
Yeah, and it's also just positioning your money between markets. This came up yesterday, where you guys bought for this client 18 months ago. He's Melbourne, loves Melbourne, bought there himself as a first home buyer back in 2020, 2021. He did a bit on the back of that. Market hadn't really done anything. He has been able to create capital himself. There was a bit of equity in the property, but it was the education of going, let's just assess options outside of Melbourne. Let's have a look, use a buyer's agent, put the trust in that. That property is his best performing asset, which is now getting him into property number 3.
Yeah.
Which he could have done 12 months ago. But again, there was a few other personal things going on. But if he hadn't done that, the opportunity cost of him buying in his backyard, which he wanted to do, we'd be sitting in an okay position. There would have been an uplift. Like Melbourne did okay. You know, it started to make a resurgence last year. Hasn't done the numbers that other states have done. But, you know, it's just the timing of those markets. And the fee to engage buyer's agent, he doesn't even remember what it was because look at the upside in the property, the wealth creation that's happened. Yeah. So it's just it's a time at the moment where you just need to slow down, get the right advice, have the right team around you, have an accountant that understands your bigger plan, isn't just looking at the transaction. There's been a couple of accountants over the last 2 weeks that have told clients not to buy when they've got liquidity, they've got equity, and the opportunity cost of doing nothing has never worked really for anyone, has it?
No.
Keeping money as cash.
Look, I love a really savvy, astute accountant. I do. But there's a very clear difference around the knowledge of what money does from a broker to an accountant. And I think, this is where you come in, is that you've got
it's also having an accountant with the right resources behind them. Most of these, like these couple of accountants that I'm thinking about, you can tell they're a smaller team.
Yeah.
They're an older accountant. They're a bit more conservative, but not conservative in a good way, almost over conservative and pushing their own beliefs onto the client rather than looking at the client going, we've got a trading business. One of them had, they were allied health. They've got a few clinics. They've got money in the bank. They've got exceptional equity in their property. Very strong position. If they don't invest, they're just sitting there for a period of time until something gets announced.
Yeah.
Then they're ready to go because the accountant's got 100% assurance that this is the right way. When we can take steps to, ownership structures to mitigate what the effects could be if everything gets legislated that's been proposed, as is, face value, nothing changes, versus sitting there and doing nothing. And it's just hard. We're never ones to push clients into transactions.
Yeah.
It's about having the education around it and speaking with the right people to make sure that you've got all the advice that you need to go, yep, that is the right way to go, and this is the way I'm doing it here, and that makes sense here.
Education is everything.
Everything.
It's for all 3 departments of the process, the accounting, the brokering, and the buying. Education needs to stack up. And I think there's just no connection. Well, hold on. I won't say there's no connection. I'll just say there's not enough of a transparent connection between all developments of the process and how they line up to the end goal being the thing that you're actually trying to achieve. There's a disconnect.
Yeah, and it's just a little bit of a frustration because the accountant is every business owner and every professional staple.
Yeah,
right. You've got a good accountant. I had tax planning last Friday with my accountant. Completely invaluable.
How fun is that?
Completely invaluable though, because they're throwing stuff at you that makes sense. That as a business owner and as an investor, you've got so much on your plate day to day that it's nice having someone there to sense check everything, run stuff by.
Yep. Crunch the numbers, put new strategy plays together, understand what your opportunities look like, see where you can diversify. Like it's when I say how fun is that, I actually meant like how fun is it?
No,
like,
I love it.
It's actually great because
it's my wife and I
on
the call, and it's also good to look across different businesses, different structures as well to look at how we're minimising tax, retaining borrowing, topping up super, like doing all the bits of a diversified piece. But, not all accountants have the opportunity of that. Some of them are small, some of them don't have the resources, but it's frustrating to see clients with those accountants because we don't want to push clients out of an accountant into a different one. But it's hard to watch an accountant undervaluing a client's position.
Yeah.
Especially if there's a family connection there, family friend, this is my parents' accountant, etc.
Yeah. So I think, that kind of really connects well with you buy a property and you're going to put it in a vehicle. Mm-hmm. Those are the 2 heads that need to really understand each other.
A lot of financial planners want to steer you only into shares, but again, that's got to be nuanced.
Yeah, and I think financial planners are important because they position what strategies potentially could work to navigate around what also the tax accountants will give you advice on according to the legislations that get put in place, which then allow you to understand what mortgages to take out if you need to put towards buying property or assets or whatever it is. what I'm trying to get at is that throughout history, while sentiment has been low, there have been a panel of people who have been able to support you and navigate you through to the right position and the right decisions to make. That's why these people exist. And really...
And almost none of them are telling you to do nothing.
No, 100%. In fact, sitting on a nothing decision is the opportunity of loss, and we've spoken about that already. But I think the more that people realize that this is just another decision in another time that'll have an impact, yes, but doesn't play a big part of at least the property game of fundamentals, it will impact the short term. And we have seen this obviously in the three areas which the media talks about, Sydney, Brisbane and Melbourne, being that the sentiment has dropped and obviously property prices have loosened up. That is going to happen, but that is an opportunity to then enter that market because property prices have dropped. And again, going back to the exact same thing that I said earlier, that we look for these areas, and we have been for the last 4 or 5 years, 6 years, 7 years. As long as the business has been in operation, this is what we look for. We look for properties that are at the bottom of the market and understand when they're going to be rising. Right now, we wouldn't be buying in these metropolitan areas because they're not yet due to rise just yet, but we're watching them. And that's the bottom line, really.
It has been affected by borrowing as well.
Yeah,
that's been something that's washed through over the last few weeks, and there's still a few banks that have made decisions that come into effect next week as well.
Yep.
So if we look at personal name, I'm buying an investment property, personal name, it's going to be negatively geared as a product of I'm using equity in one property to go buy another property, so I'm buying it at 100%. Loan secured between a couple of assets. You've seen it's around a 19 to 20% drop in borrowing, and it's not an exact number because it really depends on what your income is, what tax bracket you're in, and how close you are to tipping over up into the top tax bracket or upper tax bracket. Because if you can apply negative gearing that drops you a tax bracket, it has a bigger impact on borrowing for the better. So that has been something that's washed through pretty much across most lenders now.
Yeah.
That has given those investors, especially early on, a bit of a haircut. You're still buying in personal name. You don't have the capital to go set up an SPV to buy an SPV.
Yeah. So that does impact sentiment.
It impacts sentiment and also feasibility.
Yeah.
But
because when you were able to go 900 and now you're only able to go like 650, whatever it might be, you feel that.
Yep.
Yeah.
And for a lot of people that again, younger accumulators that are trying to get into asset 1, asset 2, asset 3, it does affect things because you don't have a huge amount of capital. You've got enough equity to deploy, but your borrowing is affected because of the negative gearing because you're still buying in personal name. You haven't stepped to SPV yet.
And this actually plays into two big parts of our process of prediction where the property market will go based off this negative gearing change if it comes into effect. One being the serviceability drop, which puts people into different price point markets, which will then erupt that portion of the market. But the other side of it is that when you take negative gearing away from an astute investor, the cashed up investor that's buying $2, $3, $4 million properties that would have got those gains from negative gearing don't get them anymore. Do they want to go into new builds to get them? Typically, if you're educated enough, you'd understand that it takes 24 months to build a new property and then 3 to 5 years for the median to correct itself. So you're on a 7-year wait game until you buy that property, and then it actually depreciates to the point of median value to then start growing value again. Nobody really wants to wait 7 years for that. So where are those investors then going to go? They're going to be priced down to the lower price point market because of the drop in serviceability, but also the attractiveness that the yields hold in those lower price point markets, because that's where they're going to get their gains from, which which the negative gearing incentives have then been pulled away from them.
Yep.
So that whole middle belt is going to be very, very competitive.
I agree.
Sitting at that 450 to 900 range mark, and that's kind of where the nation's affordability of buying sits. And so that's where we're going to start to see property prices grow up over the next sort of 36 to 48 months, while the top of the market, the top percentile, start to relax because the competition won't exist as much there because there's less desires for investors to really buy there. However, that rental market will most likely skyrocket because that's the expensive asset that is not being supported by investors.
Yep.
And so people do still want to rent those assets, but they're going to be very expensive to rent. So what happens to that market? Those people will come back down to a buying market,
Yep.
and they will geographically move around to find their price point. And again, fuel up the middle belt. And this is the side of the economics which haven't really been considered.
And that's no, I 100% agree.
Thanks.
We've sort of got, I guess, two bands of clients.
Yeah.
Predominantly, this band of clients is on fairly fixed income. That they have limited scope to build, that next stage of wealth through, I guess, them getting large pay increases or large additional remuneration to their base, or capped bonuses and stuff like that. So they need to look outside of employment to build wealth. They're the ones that are buying in that bracket that you said. A lot of them sit in that sort of, call it 500 to $1 million, okay, depending on where we are, what we're buying. And they would have a larger degree of comfort of doing multiple assets in that band than over-indexing in one. Then we've got the guys that are printing cash. They're the guys that are your business owners. They're your investment bankers. They're your tech sales guys that, again, have base but large additional REM that drops, and we need to know where to put it, what to do with it. So those people are then spending a bit more because they might go into a high-end duplex. Again, not a bad rental return. They buy an asset that is between, say, 1.2 and 2.5, blue chip, and proportionate to, I guess, value upside that they see versus rental return. That's not too bad. That's pretty good. Or commercial, or unit blocks. We've probably got 6 or 8 investors at the moment that are chasing unit blocks between 4 and 7.
That's the goal there,
which are phenomenal.
Yeah, because those are the engines that are going to help to support that servicing that's been decreased by these decisions.
But again, you need 2 to 3 mil, 2 to 3.5 mil to 100%. Buy them, which either comes from a very profitable trading business, retained earnings passed across into a different SPV to buy. It's not coming from this other band of investors, which is a lot of people, and there's a lot of comfort in that. You can still earn a lot of money, and a lot of people will want to sit here. Yeah. And then once equity permits, they step into commercial. They step out of that, chasing a little bit more of something that's going to increase in value, store of value, but get validated from the passive income side of things. And it's probably not passive at the start. Yeah. But again,
in these days and age, it's very hard to find anything that's going to be passive at the start. Yeah.
Unless there's a large injection, injection of cash liquidity event that happens. Yeah.
I think let's sort of leave it at this for now, because I think really what we're trying to show here is that there are so many opportunities for people to make the right decisions. There's partners to speak to help them get the education and the assistance to put their funds into an area that will return well, especially in property, because there are more than 3 markets. Going to keep hammering on that. But there's history which has happened, and history has had these causations of sentiment drop, yet property prices continue. Sentiment is not a direct long-term relation to property prices. It is a short-term relation, and it is a geographic relationship. It's
just a reaction. That's all it is. It's a blip on the radar. There's plenty of sort of macro reactions to stuff that's announced.
Yeah,
that's fine. That's cool. It's just internalizing what those reactions are. Yeah. How is it going to affect me with what I've got? How's it going to affect my decisions? Property we're not buying as a pump and dump 12-month, 2-year win.
You can't do that. It was never designed for that.
Never designed for that. There's too many transaction costs on the way in, the way out. So as long as you've got your fundamentals right, you've got your price points right, you've got your structures right to hold, and you've got your liquidity buffers as well to weather the storms of rates, weather the storms of, a tenant leaving, resi property, 30 days. Vacancies are pretty tight.
Yeah, 100%. Until the long-term factors are corrected, which will take many, 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 many years. It's not like we can cut off population movement. We need the economy to continue to be stimulated. And we've got a higher population movement into the country than we do a birth rate at this stage. So we need population, and it just needs to be controlled better. So does development of property need to be controlled better, and so does the legislative policies around money and taxes be controlled better. But it doesn't mean that demand will not be there, and demand is what grows the property values.
Yep.
Ben, thank you so much for your time today, mate. We always love having you in. Always a good yarn. It's always really fun to unpack these ideas with you.
Mate, it's been fun. There's plenty to talk about at the moment, but I think it's just if everyone slows down and has a thirst for information, that's probably the key takeaway here, right?
I love that, a thirst for information. So go and educate yourselves. Guys, there's Claude everywhere.
Read.
Yeah.
Claude podcast.
Just
Again,
make sure Claude's
education and perspective.
Yeah.
Don't listen to one thing. Go take an average of 5 or 10 things that you listen and you research and form your own opinion.
Totally, yeah. Because whatever you find out today is going to be specific to the question that you asked. But have you asked the right question? Potentially not. Go educate yourself. There's so much information out there, so much resource. I think it's always just eye-opening having another discussion around these things with somebody else who plays on that field so much, and we really appreciate your opinion on these things, mate. Thank you so much for coming in, and we'll catch you again the next time. We'll probably see you in a few months. We like having you in. If you want to come back down,
definitely,
we'll do that again.
It's always a fun chat.
Cheers, Benny. Thanks, mate.